When approaching retirement, one of the most significant decisions Canadians face is when to take CPP. Although it is such an important decision and the timing is crucial for retirement, we've realized that many Canadians take it at the wrong time. Or even more common, they have no idea what the real differences are between taking it at 60, 65, or 70, or how it impacts the rest of their retirement plan.
So in this episode, we're going to walk through an illustrative case study, which we'll call Mark, to show how this decision works in real life. Mark is at an age when CPP timing really matters. He has investments, and like many Canadians, he's trying to figure out the best strategy for his long-term income. And through working with clients like Mark, we've discovered something important. CPP isn't just a monthly number, it's an income lever that when you pull it, it affects everything else in retirement. RSPs, TFSAs, old age security, and most importantly, taxes.
I'm Carlo Cancino.
And I'm John Iaconetti.
We're financial advisors with the McClellan Financial Group, and today we'll show you exactly what drives the decision, why early isn't always better, and why waiting isn't always necessary, and how to build a plan that breathes instead of using investments to fix gaps that CPP could have covered. All right, let's start with Mark's scenario. He's considering taking CPP at 60, but what does that mean?
Well, taking CPP at 60 comes with a permanent reduction. Right now, the reduction is about 36% compared to the full benefit at age 65. That's not temporary, that's going to be for life. Every cost of living adjustment thereafter is applied to that smaller base. So if Mark's full CPP at 65 would be roughly about $1,200 a month, taking it at 60 reduces it to about $770 a month. And that gap widens over time because inflation adjustments are applied to both, meaning the smaller starting number stays smaller.
A lot of Canadians don't realize this. They think they will catch up eventually, but no, the reduction, it never goes away. So knowing this, when does taking CPP at 60 make sense? Well, there are a few scenarios. So scenario one, immediate income needs. If you can't cover expenses otherwise, taking CPP early gives cash flow right away. Scenario number two, health or longevity concerns. So if you have health issues or a family history suggesting a shorter lifespan, early CPP can maximize the total lifetime income. And then scenario three, portfolio stress reduction. If you're retiring into a down market, early CPP reduces the need to sell investments at a loss to cover your expenses.
Exactly. I mean, for someone like Mark who expects retirement maybe into his mid-70s rather than 90, taking CPP early could result in more total dollars collected because he's collecting for more years, even though the monthly number is smaller.
So in short, less per month, but immediate cash flow. But now let's compare that with waiting until age 65.
So let's analyze what happens if Mark waits until 65 to pull out CPP. Well, at 65, you get the full unreduced benefit, roughly 36% more than the earlier amount. So that's $770 a month at 60 now comes to be about $1,200 a month at age 65. An extra $430 a month or over $5,000 a year for life. And that gap grows over time. By your 80s, the difference could be $600 to $700 a month over a 25-year retirement, adding up to over $125,000 more without selling a single investment.
Bigger CPP isn't just about the monthly number. It changes how your portfolio behaves. A higher guaranteed income means you can withdraw less from your RSPs and TFSAs, leaving more room for growth and reducing sequence of returns risk. Taking pressure off your investments for decades, not just for the year you claim. By delaying, a larger portion of expenses is covered by a guaranteed income that continues for life, reducing reliance on portfolio withdrawals later in retirement. Waiting until 65 gives Mark a bigger, safer cushion for the long term. But here's the piece most Canadians don't think about. The window between 60 and 65 is a planning opportunity. These 5 years between 60 and 65 are crucial. Many Canadians just coast through them, but they're your best window for planning. This is because income is lower, RIFs haven't started, and you still have control over your tax situation. If Mark delays CPP, he'll need to fund those years from other sources, like our RSP withdrawals or savings. But this isn't just a cost, it's an opportunity to structure things strategically. Let's see the bigger picture of what he could do during this window. Take controlled RRSP withdrawals at lower tax rates. Reduce future RIF balances, which lowers mandatory withdrawals later. And smooth income rather than spiking it. For example, $40,000 a year for 5 years instead of $80,000 a year later. So if you're thinking of delaying, use those years strategically to set up the next 25 years of retirement.
Now that you see what the 60 to 65 window can do for your CPP timing, click the link below for a free portfolio analysis to see how it fits into your retirement plan.
Now, let's talk numbers. When does taking CPP at 60 result in more total lifetime income?
The break even usually falls around 74 to 76. So if Mark doesn't live past that, taking CPP early often ends up giving him more total dollars since he's collecting for more years. So if Mark took CPP at 60 and he passes away at 72, he'd have collected 12 years worth of payments, whereas waiting until 65 would have meant he only had 7 years of larger payments. That's why health history, family longevity, and personal risk factors matter. Early CPP can make sense for people with serious health concerns.
However, if Mark lives into his mid-80s or beyond, delaying CPP almost always results in more total lifetime income. That higher monthly payment compounds over more years, keeping pace with inflation and helping protect against outliving your money.
This is the insurance value of delaying. It's not just raw math, it's protecting lifestyle and portfolio longevity. So, in the end, the math depends on how long you live, but the decision also affects how the rest of your retirement behaves. Let's look at how this choice affects the rest of Mark's plan.
Taking CPP at 60 gives immediate cash flow, reducing how much Mark needs to pull from investments early on. That's huge if the market is down. What's the trade-off? Less guaranteed income later, meaning the portfolio must work harder in your 70s and 80s. Early CPP can make someone more dependent on investments when they're least equipped to manage volatility. So delaying until 65 allows those 5 years for strategic RRSP withdrawals, lowering the future mandatory withdrawals, reducing OAS clawback, and leaving more cushion for healthcare or unexpected expenses.
The larger guaranteed income becomes the foundation, making the portfolio a supplement rather than the primary income source. The plan breathes rather than feeling forced.
CPP timing affects everything else. So now let's talk about how to figure out which approach is right for you. How do you decide what's right? Let's break it down.
Well, the factors pushing towards CPP at 60 might be that your cash flow is tight and income needs are immediate. Health issues or family history suggest a shorter lifespan. You need a predictable income to stabilize the retirement plan.
Now, taking CPP early isn't necessarily wrong. It's right for specific situations. It's knowing whether you're in that situation, which is key.
So here are the factors pushing towards CPP at age 65. You have savings to bridge the gap years. You expect a long retirement into your mid-80s or beyond. You want stronger guaranteed income and less dependence on investments.
The point isn't early versus late. The fact is that CPP is an income lever, and when you pull it, it determines how the rest of your retirement behaves. This is why CPP timing is one of the most critical decisions for Canadians. The key is in understanding it's not just about the monthly number, it's about how it affects your cash flow, investments, taxes, and retirement plan. You don't have to figure this out alone. Our goal is to help Canadians gain clear insights, feel less stressed, and make informed retirement decisions.
We share content to help Canadians understand retirement in a practical, actionable way. If you want a closer look at your own situation, a free portfolio analysis can show you how your investments are performing, highlight some gaps, and give you a clearer picture on your next steps. Click the link in the description to get started.
We'll see you in the following video.